Welcome back to the What's Your More podcast. I'm your host, Quinton Harris. You are dialed into episode 236 here on Monday morning. So it is the kickoff of March, and it's kind of rounding out the first quarter. And man, we are excited about this episode because I'm going to talk to you about the PCE, the Fed's favorite form of inflation that came out Friday, the reading, what that means. Scott Besant, his comments about the private sector. I think he's saying something we've all been saying, but no one has come out and said it yet from a public figure standpoint. That and more in this episode of What's Your One More. All right, so welcome back. So, hey, it is Monday. It is the kickoff of March. We're rounding out the first quarter. You know, I always like to reference that forecast that we put out there. I thought that this would be the turning point. You know, we have a Fed meeting in a couple of weeks coming up. There's still some content they're not going to do anything, meaning they'll continue to pause. I'm not so sure of that. I'm going to pull up the most recent CME group where it does the whole Fed watch and what's going on. And the odds of a rate cut, while small, are continuing to increase. Friday we've got the PCE reading that came out, which is the Fed's favorite form of inflation. Obviously, we get the overall year-over-year index, and then we get the core reading as well. Why is this important? Because the Fed is continuing to say, hey, listen, it's the labor market over inflation. However, we do want to make sure that inflation stays at the 2% target rate, and that's our job to get it there. But they've made numerous commentaries now that it's not requiring any type of rate hike to get it there. They've also insinuated that, listen, we expect higher readings coming out of the month of January. So the reading we get in February is for January, which is what we're talking about. Those are traditionally high anyways. They typically are hot coming off the January reading 9 out of 10 times over the last 10 years. So the most recent reading we got came in as expected at the forecast at 0.3. So we're replacing last year's reading this time to get an overall 12-month average. And the reality is that it came in at, it rounds up because it came in at 0.285. So slightly lower than expected, but they round up. So it's 0.3. The markets are reacting favorably to this. I think that's adding to our forecast as well. If you go back to our forecast, one of the things we've talked about is the Federal Reserve really doesn't have to do anything. Of course, we want them to lower the rates, but they don't have to do anything for this rate to come down. Right now, there appears one of the major points of this administration is to lower the 10-year yield. Matter of fact, the U.S. Treasury Secretary Scott Besant has come out and said that is what we think is an issue that needs to be addressed. We don't need the Federal Reserve to lower rates. If they do and they feel compelled to do it, great. But we think that the economy right now is being held back by the 10-year Treasury. And so they have made multiple attempts to get this down, and I think they're going to continue to do it through commentary only at this point. But that goes a long way in the market. And since our last episode, we're continuing to see this rally, if you may, in the bond market that supports those theories. And it's been really good to see. And, I'm going to put this graph on our YouTube channel at What's Your One More. That's with a number 1 at What's Your One More. And if you're not subscribed to that, you're listening to our audio, go subscribe to that because there's some cool stuff our producer puts in there that I think just really takes these episodes to another level. And I really appreciate all the feedback you guys put in there and ask for more, data sets that we put in there. But I'm going to drop this graph of this 10-year Treasury in there and look at the actual downward pressure that's been happening since really dating back to right at Valentine's Day. Like if we start at February 14th, it has been a nice trajectory down, and we've seen a 40-point differential, 40 basis point differential in the 10-year Treasury. That's extremely important because what's happened is as that comes down, so do mortgage interest rates. And if you're in the mortgage side of things, you've seen that since that time frame. Matter of fact, in the last week, you've seen a pretty good drop off in the pricing, not necessarily the rate, but the pricing side of things, which have made some rates that were maybe, accompanied by a discount point now accompanied by no discount points, which means you're able to offer lower rates with that same discount point. I think that's very consumer advantageous and is continuing to open up the affordability side of things on the market. The other thing I thought that was interesting is we've got some commentary, 2 different commentaries this week that I kind of want to talk about. One, I'm briefly going to talk about because I'm going to bring an expert on the show next week. We're going to sit down with a former government official to kind of talk a little bit about this. But we've got our own governor here in our backyard. Talk about coming out and opening up affordability and creating more opportunities for Floridians. Governor DeSantis has recently proposed the notion to eliminate property taxes for all. Now, I think there's a lot of, well, if you do that, where does the government spending come from? And how do we balance a budget with that? And that's why I'm bringing an expert on the show, because offline, I've talked to him briefly about his thoughts on this. I was blown away by his response because it's not what I thought. And I think it's going to be really cool for you guys to hear this. But what a genius idea. If they're able to eliminate property taxes, talk about opening up affordability. Maybe we can tackle the insurance problem here in Florida as well. And then all of a sudden, we create an enormous amount of affordability for homeowners and potential homeowners. I think it's a wonderful idea, and it continues to show out of the box thinking that we just haven't seen before in any type of government really sector. And I think that that's really, really important. If some of the stuff we're talking about on the podcast interests you and you're like, hey, Q, I want to be a homeowner. I want to buy an investment property. I want strategies on how I can take advantage of the market. I have a solution for you. And that solution is Loan People, to where it's all about the people getting the loan and the people doing the loan. You guys know me by now. I've been doing this podcast for years, but I've been in the mortgage business for 23. And it's very rare you can find a company that has a mantra for loan officers, by loan officers. And what does that mean? That means you have a company that's designed to help provide the best atmosphere for loan officers possibly imagined. And not only that, the most efficient operations for those loan officers to be successful, which provides a better customer service. And that's what you get at Loan People. So much so that they put that in the company name. And at the heart of this is the people. It's in-house processing, it's underwriting, it's closing and funding. And why choose them? They got great rates. They close on time and they have award-winning service. So check them out at loanpeoplejax.com. That's loanpeoplejax.com. Going back to Scott Besant, though, this is important because as the U.S. Secretary of Treasury, he opened up and said something that I thought was really interesting. And it was this. It was that if you take a look at the U.S. economy, I'm quoting, this is his first, in February, February 25th was his first address to the public in this position. He said, the U.S. economy, I'm reading the line here, is more fragile under the surface than the economic metrics suggest. That's important because I think if you've been listening to the show for some time, we've talked about there's a lot of metrics that have come out that kind of given these false narratives that, hey, we're in a strong economy. Things are good. We're thriving. GDP is up. Job growth is steady. I've been kind of warning and leaning towards the side that those numbers are not adding up. There's constant revisions to the labor force. There's constant corrections to the economic data that's coming in 60 days after it's already come in. It's a lot of it that rebutes this idea of a strong economy. And quite frankly, I mean, look around. Look around to where you are. I think you can see weakening signs of people struggling. And I don't think that this economy is as strong as we were led to once believe. And, I think that's going to add to the Federal Reserve making these cuts that I'm continuing to forecast at 4, not 2. There will be 4 cuts, maybe even 6 on this year that are coming. Going back to my forecast, I said the peak of the opportunity as a home buyer will be in the late Q2, early Q3 sector of this year, because I think that's when we're going to see the lowest of the rates this year in that range that we suggested, somewhere between 5.875 and 7.25. You'll be on the lower end of that range. But I understand that what Scott Besant is saying here, because I'm pulling up his commentary. I thought this was really important, and I definitely want to go. He said the private sector has been in a recession, and I tend to agree that there are sectors that are in a rolling recession. But for him to come out and address this, I think it was kind of one of those wake ups to the market that was like, wait a minute, like, hey, that's kind of not what we've been told. It's not what we've been seeing on the news. It's a lot different, and I think that this is the sign of the government coming out and kind of spilling the beans, if you may. And I think that that's going to bleed right over to the Federal Reserve. And I think you're going to see some favorable market conditions that we're just now hitting the momentum. And we suggested in that forecast in March would be the run-up. And here we are. We're not even at March yet, and we're already seeing it. It started mid-February. This could propel us into a very nice home buying season here in the spring. And if you're a home buyer, something that I think you really have to consider right now. I'm going to talk to home buyers specifically on this commentary. There's a lot of you out there right now. Not all of you are actively searching for the home at this moment. You have it on your horizon over the next 90 days, maybe over the next 6 months. However, if you get it on your horizon now to plan for the next 30 to 60 days, you may beat all of the competition to the market. That competition that's going to come to the market may enter the market at lower rates than we've seen over the last 18 months, which is going to cause a flurry of home buyers. And that is potentially going to increase home prices higher than anticipated. For example, if you're a seller, something to think about. Now might be your time to list the property. You have less competition now. There are less homes on the market right now, historically speaking, than there will be in May or June. So you should be able to list your home now. If you're on the fence and you're like, well, I think we're going to list maybe the next 69 days. It might not be a bad idea to do it now because you're going to get probably exactly what you want for the home, maybe even a little bit more in a multiple offer situation. I have a friend that recently, he wasn't prepared to sell his home, but he said, my wife and I were going to sell our home. Mother-in-law passed away. They were handling her affairs and they were like, we're going to go move into her home. We'll list our home. We'll figure things out. That thing sold in 48 hours with multiple offers. And they were floored it went that quickly, to the point they didn't have enough time to move everything out. My point is that there is an appetite in this market for homes that buyers are willing to take on right now. And if you're a seller, this is your time to do it in the form of getting out there and getting ahead of the competition, because less homes that are listed, the more opportunity that your home is desired by the buyers that are out there wanting to buy. And I think this is a trend that's naturally, I'm not setting the world on fire with this theory, but it's starting to become more robust now than ever before, especially with the amount of limited listings that we've had over the course of the last really 30, 60 days. And, as I continue to talk, you're starting to see more downward trajectory on this 10-year Treasury, which is great news. And, there's a theology, man. If this thing gets below, it's at 4.23 right now. If it gets below 4, that's not going to happen today, but if it gets below 4, that's a really big threshold that we're going to break, that I think imposes a lot of opportunity in the market that wasn't there 6 months ago. It's something I'm very excited about. You can probably hear it in how I'm talking about it, but I think that is something that I think it's a really good sign. Again, going back to the Federal Reserve, they can still hit pause again. It doesn't matter if that 10-year keeps coming down. That plus, if you recall, when we did the whole How to Make a Mortgage podcast, that plus the spread, which also is continuing to come down, is how you make your mortgage interest rate. There's a very good chance we're in the low to mid 6s by mid-March. There's a very good chance that happens. And if you were thinking that, 3 months ago, you'd be like, man, there's no way we're going to be there by March. It absolutely looks like that's the way we're heading right now. And it's very exciting times and a great opportunity. And if you couple that with the traditional discount point that you're seeing on a loan right now, you're in the low 6s, maybe even upper 5s, depending on how you structure that. Great opportunity out there, and it's something that I'm very excited about as we kind of head into a year. And I think we're all deserving of that, man. We've been on the line. We've been waiting since late 22, really for some sort of rally to come back and some sort of opportunity and just stability in the market. And it looks like it's presenting itself right now. And that's something that I think is highly anticipated and very welcomed in this market there. So guys, if you like what you're hearing, please share this podcast. If you would, share a friend, family member, someone you're talking to that's looking to be a homeowner, maybe on the fence, maybe not. We'd love to hear your comments and your feedback on our YouTube channel at What's Your One More. And until the next episode, we'll see you guys at What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.